Accounting is like telling the financial story of a business step by step. Let's walk through the cycle together. Step 1. Identify transactions. First, we identify what happened. Did the business sell something, buy supplies, pay salaries? Every event that affects money must be recognized as a transaction. Example, a store sells a pair of shoes for $50. That's a transaction. Step 2. Record transactions in a journal. Next, we write it down in the journal. This is like the diary of the business, recording everything in order with debits and credits. Step 3. Post transactions. Now, we take those journal entries and move them into the ledger. Think of the ledger as folders that organize transactions by account. One folder for cash, one for sales, one for expenses, and so on. Step 4. Prepare an unadjusted trial balance. After posting, we check our math with a trial balance. We list all the accounts and make sure that total debits equal total credits. If they don't, something went wrong. Step 5. Prepare adjusting entries and an adjusted trial balance. Before we can make reports, we need to adjust. Some things aren't recorded yet, like unpaid salaries or rent that's been used up. Adjusting entries fix that. Then we prepare an adjusted trial balance to double-check accuracy. Step 6. Prepare financial statements. Now comes the big reveal, financial statements. From our adjusted balances, we prepare the income statement, balance sheet, and cash flow statement. These tell the story of how the business performed. Step 7. Prepare closing entries. After the reports are done, we close temporary accounts like revenues and expenses. This resets them to 0 so the next period can start fresh. Step 8. Prepare a post-closing trial balance. Finally, we prepare one more trial balance. This post-closing trial balance makes sure only permanent accounts, assets, liabilities, and equity remain open. Now the cycle is complete, and we're ready for the next period. Conclusion. So, the accounting cycle is like preparing a financial report card. We gather, record, organize, check, adjust, report, close, and reset. Step by step, it ensures the financial story is complete and accurate. Let's talk about the ledger and the chart of accounts, two important parts of the accounting system. First, the ledger. The ledger is basically the collection of all accounts a company uses. Each account shows its balance. For example, how much cash we have, how much customers owe us, or how much we owe suppliers. Think of it like a big filing cabinet where each folder is an account, and the ledger holds all the folders together. Next, we have the chart of accounts. The chart of accounts is simply a list of all the accounts in the ledger, with a unique number or code for each account. It's like a table of contents in a book. It helps you quickly find where things are recorded. For example, account 101 might be cash, 201 might be accounts payable, and so on. Let's go through the steps of journalizing business transactions. Step 1. Identify transactions and source documents. Every transaction starts with evidence, like a sales receipt, a service contract, a purchase order, or a bank statement. These documents prove the transaction happened. Step 2. Analyze the transaction using the accounting equation. Next, we figure out how the transaction affects the business. Remember our equation. Assets equals liabilities plus equity. Does cash go up, does debt increase, or does owner's equity change? Step 3. Record the journal entry. Once we know the effect, we write it in the journal using debits and credits. This is the business's diary, listing transactions in order by date. Step 4. Post the entry to the ledger. Finally, we transfer the journal entry into the ledger. The ledger organizes information by account. So the cash account, supplies account, or common stock account shows the full history of changes. Here is an example of the proper recording of a general journal transaction. We have seen a similar transaction before. In this case, the owner of the business contributes $30,000 cash to start the business. The transaction occurred on December 1st, 2020. The date is important when recording general journal transactions and is recorded on the left side of the journal. Next, we identify the accounts affected by the transactions. The cash account is an asset that has increased. We show increases in asset accounts with a debit to that account. The common stock account also increased, and we show increases in equity accounts with a credit. Debits are always listed first in the journal, followed by credits that are slightly indented below the debits. The dollar amount is placed in the appropriate debit or credit column. In this case, the cash account was debited for $30,000, so we place that amount in the debit column. Finally, we prepare a brief description of the transaction so that other people who view our work will understand the nature of the transaction. This explanation is indented about as far as the credited account titles to avoid confusing it with accounts, and it is italicized. When a transaction is first recorded, the posting reference PR column is left blank in a manual system. Later, when posting entries to the ledger, the identification numbers of the individual ledger accounts are entered in the PR column. Then, we go back to the journal and write the cash accounts number, 101, in the PR column. linking the journal to the ledger. Next, we identify the credit account. Common stock increases, so we credit common stock for $30,000. In the common stock ledger, we enter the same information: the date, journal page number, credit amount, and balance. Finally, we return to the journal and write the common stock account number 307 in the PR column. This cross-referencing ensures we can always trace the transaction both ways, from the journal to the ledger and from the ledger back to the journal. After we post all transactions to the ledger, we need to check if everything still balances. That's where the trial balance comes in. Step 1. List accounts and balances. We start by listing each account title from the ledger along with its ending balance. This gives us one big summary table of all accounts. Step 2. Add up debit and credit totals. Next, we add together all the debit balances and all the credit balances. Step 3. Verify equality. Finally, we check if total debits equal total credits. If they match, it means our books are in balance. If not, we know there's an error that needs fixing. So the trial balance is like a checkpoint, a way to prove that our accounting equation, assets equals liabilities plus equity, is still holding true. So as you can see, the trial balance lists all ledger accounts and their balances at a point in time. If the books are in balance, the total debits will equal the total credits. If the trial balance does not balance, the errors must be found and corrected. Verify the columns are added correctly. Verify account balances are correctly entered from the ledger. See if debit or credit accounts are mistakenly placed. Recompute each account balance in the ledger. Verify that each journal entry is posted correctly. Verify that each journal entry has equal debits and credits. Sometimes, even after preparing a trial balance, debits and credits don't match. That means there's an error somewhere. Instead of checking everything line by line right away, we can use two quick tricks to narrow down the problem. Trick 1. Divide the difference by 9. If the difference between total debits and credits can be divided evenly by 9, it's often a transposition error. A transposition error happens when numbers are flipped. For example, writing 540 instead of 450. The difference between these is 90, and 90 divided by 9 equals 1010, which tells us the error is likely a transposition. And trick 2 is to divide the difference by 2. If the difference can be divided evenly by 2, it may mean that a debit was recorded as a credit, or vice versa. For example, if you should have debited $500 but instead credited it, the trial balance would be off by $1,000. That $1,000 difference divided by 2 equals $500, which points you to the wrong entry. The next thing we need to do is adjusting entries. Let's talk about prepaid expenses. A prepaid expense is when a business pays for something in advance before actually using it. At first, that payment is considered an asset because it gives the business a future benefit. For example, if we pay rent for 6 months today, that payment is not immediately an expense. It's an asset called prepaid rent. Each month, as we use the building, part of that prepaid rent becomes an expense. The same idea works for prepaid insurance or even office supplies. When you buy them, they are assets. As you use them, they slowly turn into expenses. Now, here's what happens in accounting. We decrease the asset account because we've used up part of it. We increase the expense account because we're recording the cost for the period, so the adjusting entry is always debit expense, credit asset. This adjustment makes sure our books are accurate, showing fewer assets left and the right amount of expense recorded for the time period. When a business buys something big like equipment, a building, or a car, it wouldn't make sense to treat the whole purchase as an expense in just 1 year, because the business will use it for many years. Instead of recording the cost all at once, we spread out the cost over the asset's useful life. That spreading out is called depreciation. Think of it like this. If a company buys a delivery van for $30,000 and expects it to last 5 years, we don't expense $30,000 right away. Instead, we expense a part of it each year to match the cost with the revenue it helps generate. The formula for straight line depreciation is depreciation expense equals asset cost minus salvage value divided by useful life, where asset cost equals what you paid for it, salvage value equals what you think you can sell it for at the end of its life. Useful life equals how many years you expect to use it. So if the van costs $30,000, it will be worth $5,000 after 5 years and has a 5-year useful life. That means the depreciation expense is $5,000 per year. Depreciation helps us spread the cost fairly across the years the asset is used so the financial statements are more accurate. Sometimes businesses receive cash before they actually provide a product or service. When that happens, the money received is called unearned revenue. Why? Because the company hasn't earned it yet. It still owes the customer something. That's why unearned revenue is recorded first as a liability, not as income. Example: imagine a gym collects $600 in January for a 6-month membership. At the moment of payment, the gym hasn't provided 6 months of workouts yet. That $600 is a liability. The gym owes services to the customer. As each month passes and the gym provides the service, part of that liability is reduced and turned into earned revenue. The accounting entry. When adjusting, we decrease the liability because we no longer owe that portion. At the same time, we increase revenue because now we've actually earned it. So the adjusting entry is debit liability, unearned revenue, credit revenue. This adjustment makes sure the income statement shows the revenue in the correct period and the balance sheet doesn't overstate liabilities. Now let's look at accrued expenses. Accrued expenses are costs that a company has already incurred. In other words, the expense has happened, but the company hasn't paid or recorded them yet. Example: imagine employees who worked the last week of December, but payday isn't until January. The company owes salaries for December, so that's an expense in December, even though it hasn't been paid yet. Here's how we record it. We increase expense by debiting it because the cost belongs to this period. We increase liability by crediting it because the company now owes money to someone. So the adjusting entry is debit expense, credit liability. Later, when the company pays the bill or the salary, we reduce the liability. The next part of the cycle is closing entries. At the end of each accounting period, we need to close the books. This means we reset temporary accounts, like revenues, expenses, and dividends, back to zero so the new period can start fresh. Here's how it works. Step 1. Identify accounts for closing. We look at which accounts need to be cleared. These are temporary accounts, not permanent ones like assets or liabilities. Step 2. Record and post closing entries. We transfer all revenues and expenses into a special account called Income Summary. This account shows the net result for the period, whether we made a profit or a loss. Then we move that balance into retained earnings, which belongs to the owners. Step 3. Prepare a post-closing trial balance. Finally, we prepare one last trial balance to make sure the books are balanced. This time, only permanent accounts remain because all the temporary ones are reset to zero. So, closing entries are like clearing the scoreboard at the end of a game. You record the final result, then reset everything to zero so the next game starts fresh. In accounting, we divide accounts into two main categories: temporary accounts and permanent accounts. Temporary accounts include revenues, expenses, and dividends. These accounts are used to track activity for a single accounting period. At the end of the period, they are closed, reset back to zero, so that the next period can start fresh. Their balances are transferred to the income summary account and then into retained earnings. On the other hand, permanent accounts include assets, liabilities, and equity. These accounts are never closed. Their balances carry over from one period to the next because they represent the ongoing financial position of the company. So here's the key point. The closing process applies only to temporary accounts. That's why, after closing, you'll see zero balances in revenues, expenses, and dividends. But your assets, liabilities, and equity remain unchanged and continue forward.